Jason Bone from the Boole Microcap Fund. The S&P 500 index is likely to decline 30 to 50% over the next 1 to 3 years. The Shiller PE, also called the 10-year PE or the cyclically adjusted PE, the CAPE ratio, recently exceeded 34. The Shiller PE is basically the S&P 500 divided by 10-year average inflation-adjusted earnings. A Shiller PE at 34 is in the top 1% of history, so it's the top 1% most expensive the S&P 500 has ever been. As bubble historian Jeremy Grantham notes, there has never been a sustained rally starting from a 34 Shiller PE. The only bull markets that continued up from levels like this were the last 18 months in Japan in 1989 and the US tech bubble of 1998 and 1999. And those were two of the biggest bubbles ever in history, and both of those bubbles broke spectacularly. In inflation-adjusted terms, 35 years later, the Japanese stock market is still below its 1989 high. Separately, there has never been a sustained rally starting from full employment. What happened to the 2021 bubble? It seemed like it was bursting in 2022. In the first half of 2022, the S&P declined more than any first half since 1939, when Europe was entering World War II. As Grantham points out previously, in 2021, the market displayed all the classic signs of a bubble peaking: extreme investor euphoria, a rush to IPO and SPAC, and highly volatile speculative leaders beginning to fall in early 2021, even as the blue chips rose enough to carry the whole market higher, a feature unique to late-stage major bubbles of 1929, 1972, 2000, and now 2021. This historically familiar pattern was interrupted in December 2022 by the launch of ChatGPT and the public awareness of this new transformative technology, AI, which seems likely to be every bit as powerful and world-changing as the internet, and possibly much more so. But every technological revolution like this, says Grantham, going back from the internet to telephones, railroads, or canals, has been accompanied by early massive hype and a stock market bubble as investors focus on the ultimate possibilities of the technology, pricing most of the very long-term potential immediately into current market prices. And many such revolutions are in the end often as transformative as those early investors could see, and sometimes even more so, but only after a substantial period of disappointment during which the initial bubble bursts. Thus, as the most remarkable example of the tech bubble, Amazon led the speculative market, rising 21 times from the beginning of 1998 to its 1999 peak, only to decline by 92% from 2000 to 2002. Now, of course, is a world leader in retail. So it is likely to be with the current AI bubble. But, Grantham says, a new bubble within a bubble like this, even one limited to a handful of stocks, is totally unprecedented, and so history may not offer all the guidance we would hope for. Still, even though there's no clear historical analogy, the best guess is that this second investment bubble, AI, will at least temporarily deflate and probably facilitate a more normal ending to the original bubble, which paused in December 2022 because of AI stocks. So it now seems likely that the after effects of interest rate rises and the huge speculation in 2020 to 2021 and now November 2023 to today will eventually end in recession. So to sum up, the S&P 500 index is extremely overpriced. There's a lot of FOMO, that's fear of missing out, that comes along at the end of every great bubble. It's super seductive, it's hard to resist. So this bubble has crossed off all the boxes in terms of what a bubble does. It's done all the things a super bubble typically does. There was a 13-year bull market, the longest in history. There's been really crazy behavior. It needs to accelerate at something like 3 times the average rate of the bull market, and it has done so. And at the end of every super bubble, the speculative stocks start to peel off and go down, even if the broad market goes up. And this has happened. 40% of all NASDAQ stocks are down over 50% So this is the beginning of the end of the bubble. Speculative stocks go down even as the market goes up. It's a very rare condition that happened in 1929, 1972, 2000, and now it's happening again today. So it is likely that we are at the beginning of a market crash. It would be unlikely that the market would not come down roughly 50% from its peak. And it would be unusual if speculative stocks did not do worse than that. The challenge is, when does it actually start? And is it slow or is it quick? In 2000, it took around 3 years for the bubble to unwind. In 2007, it took a little over a year and a half. And again, we don't know exactly when the crash is going to pick up steam.